Greetings, fellow investors. Welcome to the Financial Podcast. My name is Lucas,
And my name is Marcus, and today we're going to talk about options.
and options is a bit of an unknown topic for me, so I think Marcus is going to take the lead on this one.
Yeah, I think for a lot of people, options is somewhat of a unexplored financial instrument to use, and I think that is for good reasons because the first thing I want to talk about, or the first thing I want to say about options is that if you are a new investor, if you just started out, if you're not really sure what you're doing, this options is probably not for you. I mean, it's a very good tool to use if you know how to use it. I can't say that I am 100% sure how it's best used, how it should be used. And I also probably should say that neither of us has actually invested in options here at the beginning.
Nor do we plan to in the near future.
Yeah, I actually have no plans on investing in options for a while because, as far as I can tell, no one has really recommended options for budding investors. You should probably be well into the game and know what you're doing before you even try to start buying or selling options. And
Yeah, couldn't agree more.
yeah, and that's probably the first thing about options is that options is actually between buyer and seller very directly compared to other types of the stock market. So, for instance, when you take an option, one person is wanting to buy a certain share at a certain point in time for a certain price. And there is also a seller who will agree to this sale at this price at this point in time. And for this, all he wants is a certain fee, so to speak, a
Mm.
premium. Now, the thing with options is that you can kind of, as the buyer, you have a very good position because you have made a contract that at a certain point in time you can buy a share if it has, and you can buy it for the agreed upon price, even though it has increased in value. So then you will get a share that is, so to speak, overvalued for a lower price, which is, of course, a great deal, right? But say the share has dropped in price when you want to buy it, then you would lose money if you purchase the share for the first agreed upon price. Say you want to buy a share for $100 1 year from now from a certain seller, and the seller agrees to that, but when the year has passed, the share is $80. Then you would lose $20 if you actually made the purchase. As the buyer, though, you don't really have to make this purchase. You've only, with the options, you only bought the right to buy it if you wanted to at that point in time. So this is a great way for the buyer to kind of leverage the risk so that it's not as big because you don't really have to buy the share if you don't want to. You only have to buy it if it has increased in value. But then you can ask the question, what does the seller get out of this? Because the buyer doesn't have to buy the share. The only thing the seller can earn money on with options is actually the premiums that they put on the options. So the fee they take for allowing the buyer to make this contract, so to speak. Say we had the example that you buy a share for $100 1 year from now. So if the buyer wants to take this contract, he actually has to pay $120 for the contract. So he has to pay 100 for the share and $20 in the premium. And
Mm.
in the case that the share's value goes down, then the seller still gets to keep the $20, even though the buyer is not going to make the purchase. So he has
Wait,
earned
wait, 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 wait,
$20.
wait. Wait, hold up.
Yeah,
Wait,
okay.
that part I didn't get from your explanation, so I want to clarify that. So even when you don't buy the share, which is then it's already worst for the seller, you don't even have to pay the premium.
No, you have to pay the premium. You always
Yeah,
have to.
yeah, the premium you have to pay. Okay, yeah, thank God, because otherwise it would be completely one-sided.
Yeah, yeah,
Okay,
exactly.
okay, okay, good. Okay, I misunderstood you then.
Yeah, okay. Well, options are kind of complicated. What we are talking about
Mm.
here is also extremely basic. There's so much more you actually need to know about this, like different
Mm.
points in time when it's worth to sell, all of this stuff. I'm not even going to go into that. I'm just trying to explain the basic concept of an option. If you actually want to
Mm.
know how to best use it, uh, when to trade them, put out, should you sell, should you buy, if you want this kind of information, you definitely have to use different sources than us because I think you have to go to someone that has actually bought and or sold preferably both in options. What I have gathered so far, though, is that in general, it's better to be the buyer of options, because then all you possibly could lose is the premium, which is varying. I mean, it can be really steep, or it could be possibly pretty cheap. I guess that all comes down to risk. So as the buyer, your risks are not that high. And your earning potential is actually infinite. Say that you bought the share, you bought the share for $100 1 year after the sale was put out, and then when you actually buy the share for $100, the value of the share is now $2,000. You still only
Yeah.
pay the $100 plus the $20 premium. So you've made a great profit. And if it goes down to say $50, well, you don't make the purchase and you lost $20. Boo-hoo, you know. But as the seller, that could be really bad, because you don't want to be the seller in the position when, okay, you made the sale for 20 in premium and 100 for the actual share. And then 1 year later, the share's price is now $2,000. You just lost a lot of money, but you got $20 in premium, so that's nice.
To me, it sounds like two kids playing with each other, and they decide that they're gonna switch toys because a brat has the best toy, so they decide to switch after an hour. But then after the hour is up, the brat decides to keep it and won't give it away. So the brat's mom smuggles some candy to the other child for him to keep quiet, like hush money. That's what it sounds like to me, that you can just change if you want to buy it or not afterwards. But so I guess the question on everyone's mind now is why on earth would you engage in these sorts of
in this kind of transaction?
Yeah.
That's the big thing. For new investors, I would never recommend you to be the seller of options, because you really have to know what you're doing in that case. Because your earning potential is possibly quite low. It's only the premium. You can't earn more than that. The buyer is not going to buy them if the value of the share has fallen. The thing is, though, that you can definitely make some easy money if you're the seller, because you have to do nothing, literally nothing. You're saying that you can buy this share at this point in time for this price, and I will get a premium for offering you this. And then the buyer won't buy them, and of course the share lost value. It was going to lose value anyway. At least now you got the premium. So you got money for doing nothing.
And you could do it all over again.
Yeah, you could do it all over again, as long as people are willing to buy your option and pay the premium. So you could possibly give out lots of these options for some shares, even the same shares. I mean, if we convolute this thing a little bit, you can have the same share and sell a lot of options, and you're really counting on that nobody will actually buy them, and collect all of the premium money that they have paid. And that way you could, I think, make quite a lot of money, and very easily. But there's a lot of risk involved into that, because you have to know that, okay, nobody's going to buy these shares, and you're fairly certain that, okay, the value will probably go down so that they don't want to buy them. In the case that you can actually provide the shares you're selling, hopefully, then I guess that's less of an issue. But in general, I guess it's better if the share is losing value, because then you'll get the premium, and you couldn't prevent the shares from losing value, so at least you get the premium. As the seller, you probably want the shares to, well, you never want them to go down in that regard. I mean, they're still your shares, but if you sell them, you can at least recoup some of the damages dealt to you through the premium. So I guess that's my view on that. And that from the seller's point of view, it's all about leveraging some of your losses and turning at least part of your losses into gains through the premiums. For the buyers, it's a completely different kind of situation. You are making an incredibly safe investment in that regard, because
but again, that depends on the premium. Like if the premium is a lot of money, then it might not be so safe, because the share price could really go either way. So you might just end up paying the premium, and that's that.
Yeah, that's
so.
probably going to be the case in a lot of cases, that you just pay the premium and you get nothing, because you
Yeah,
don't.
because since these are so complicated, the one who's actually issuing the option is, I would assume, smart, since it's difficult to do this in a way that's economically lucrative for you.
Especially as the seller, so the seller is probably going to know what he's doing, and that's why I probably wouldn't recommend buying options either in that regard, even though it's safer than selling them, because the seller is probably better versed in this subject than you are. So there's a
Yeah.
high chance that you're just going to lose money and, not make anything out of it. And that's then probably the concluding part, except for our opinions, is that you should probably not get into options before you feel you have a very good sense on how investing as a whole works, and also be prepared that you're going to make some initial losses through options, either as a seller or as the buyer. You can even buy and sell options contracts, so you can sell your right to buy a share at a certain point and you can make a profit from this also. But that's a whole different kind of worms, and it's way too convoluted, so we're not going to touch upon that. All I'm going to say about all of these other things that you should know about options is that you really have to do your research and understand what you're getting into. What I just explained is the very basics of how options works, but there's so much else you need to know in order to fully use this financial tool.
Yeah, I was gonna say that. Don't you miss the days when you just went to the store and you bought something? This is not one of those situations.
No, really not. You really. This is very close to gambling. I say actually that you're gambling on this share is going to increase in value. This is going to drop in value. These kinds of things. It's more. This is also not the kind of long-term, short-term investment. It's usually a short-term, I guess.
Yeah.
But it's definitely not if you want to put away your money in some safe place and not lose a lot of money. I mean, this is very risky. So I think this is more for professional
Trader, yeah, investors and traders maybe. But it's good to know the terminologies.
altogether. Yeah, and you know that it might not be something you want to get into in the beginning. And I think that a lot of investment sites actually do offer options, and I'm not against it altogether. I might certainly try it at some point, but I really want to have all the facts when I do so. I really want to be sure that this is my view. For instance, if I'm buying an option, I want to be really sure that this option is very undervalued. They are selling to a price which this share will not be in the future. I am prepared to pay the premium to take the chance to buy this share at that point in time for this price. But you really have to do a lot of research and be sure that this company is going to be valued higher at that point.
I don't know, but if you're so sure, why not just buy the share at like today and then wait for it to go up? You know what I mean?
But why not buy the option? Then I can have the option to not buy the share and not potentially lose a lot of money when I have to sell
Yeah,
the
but
share.
you're gonna. Yeah, but okay. Yeah, so it depends. It depends on what the share value is gonna be and what the premium is gonna be. Okay.
Yeah, and how
fair
much
enough.
risk you want to. It all depends on these different kind of things. As the seller, it's completely different because then you have to be really sure that the share you're selling is probably not going to increase in value and they're not going to want to collect it. Or if they do, you're still going to make a profit from the premium. I think that one thing before we conclude the video is probably that we should mention the break-even price. Break-even price is very important because when it comes to options, the break-even price for the buyer is when the time comes to buy the share is actually worth the amount you agreed that you will pay for it, plus
the premium.
Plus the premium, exactly. So if you go above the break-even price, all's good. That's great. If you are below it, well, even though the share is now worth more than the share was than what you paid for it, the premium ate up all that money, so you still didn't earn anything. Possibly the share could, of course, go up even further after that, and then all is still pretty
so it
good.
might still be a good idea depending on the current situation, of course. But yeah, that's a good
We
point.
should probably talk briefly about our views. What do you think now that I've explained some of it?
Like again, you could always argue that to some extent investing is a little bit of gambling because you never know the future for certain. And since it's so hard to know the future, this just feels like adding extra steps to it and making the situation worse in terms of that you have more factors that you need to consider, making it more complicated because there's more things that you might have misjudged or miscalculated. So to me, it feels like if normally it would be enough that I win at a poker game, I would have to win first at a poker game and at a slot machine. But I don't know. That's maybe like I know that's not how it actually is. I do see the advantages with this, especially as the buyer, how it can be useful. But I don't know. How is it if you buy an option? It is a stock, so you don't have to sell it as an option, right? Like if I'm a buyer of an option. I buy it from you. I break even. We both fine and dandy. Everyone is happy. But then when I want to sell it, can I choose to sell it as a normal option or normal?
It's a share. You bought shares. You like the
Yeah, I bought shares.
Yeah.
Okay.
Yeah, yeah. You
Okay, so
definitely bought shares.
Mhm.
You don't have to resell it then as an option or anything. You bought strictly shares, or
yeah,
whatever
okay, because I
commodity was
wasn't.
beneath the option. I mean, the option
Yeah,
is
because
just the thing you bought from the seller, but then you get the underlying thing that you actually purchased. I think that
yeah,
could be anything basically. That's just one thing. That
yeah,
thing
it's more of
underlying,
a way of transaction.
yeah, the underlying thing that is beneath the option that you are actually buying. It could be shares, it could be funds, it could be commodities, it could be basically
Mm.
anything. So it's not
Yeah.
limited to just shares, but whatever you bought, you will get at the time of the sell, the actual sell, when the option matured, so to speak. Uh,
Yeah.
so if it's a fund, you will get a fund. If it's a commodity, you will get a commodity. All you have to do is pay the
Mm.
premium and the agreed upon price. When it comes to my view on options, I think that it's an interesting aspect, but it's like you said, it's gets even closer to gambling, which I'm not really a fan of. And for me also, I think the kicker is that I don't think that this is a good instrument for long-term investment. It's more like if you want to decrease your risks for some otherwise maybe more risky short-term purchases or things like this. I don't think that this is a good strategy to incorporate if you want to make long-term investments that are going to last you a lot of years. I think that this is more for quick money, so to speak, that you can cash out
Mm.
maybe immediately upon the option being matured. You get the shares, then you sell them immediately, for instance. Of course, you could choose
Mm.
to keep them and maybe they will be more valued in the future, but that's generally not the point, I think. The point is, as the buyer, you want the shares to increase in value over the period of time that they are not yours. And then once you get them for the agreed upon price, then you can immediately sell them with a earning afterwards. I think that this
Yeah.
is not really a strategy I want to use because I'm more for long term investment. Even
Mhm.
when it comes to shares, I plan on buying shares that I will hold for quite a long time and then sell when I see the opportune moment. With this, I don't really think I don't think it's for now a fitting strategy to incorporate in my overall strategy, so to speak.
Yeah, especially since we're also new at this.
Yeah, and don't
So I
completely
think we.
understand all the concepts of options because what we touched upon here is very basic. There are different layers that you should also be aware of. So yeah, I think for now options is it's not a good choice for any new investor.
Yeah, and I think with that I couldn't agree more. So I think we'll conclude today's episode of the financial podcast. We talked about options.
Mm.
They seem sketchy. No, I'm just joking, but they're definitely a more advanced option for you.
Yeah.
So they're option.
Wow. And I also just want to do a quick plug that if you want to get even more information, check out our videos about ETFs and index funds. They will all be kind of in tandem. You should probably watch the index funds video first, then the ETFs, and also this one, I think. Then you will get a
Yeah.
bigger picture of all the financial instruments that we will cover on this channel for now.
So with that, I guess all that's left to say is happy investing, and I'll see you next week.
Yeah, see you next week.